Each time costs climb, whether it's the weekly grocery bill, monthly rent, or the price at the pump. You feel a subtle loss of control. Your hard-earned paycheck seems to evaporate faster, stretching thinner with every passing month. This isn't just your imagination. It's the subtle mechanics of a vast, ongoing wealth redistribution, a cycle that is repeated across generations. Inflation isn't merely about rising prices. It's a force that dictates who controls tomorrow's opportunities. Welcome to the world of financial past, where economics, influence, and the past intertwine in ways that defy simplicity. For the average person, inflation evokes disorder, unpredictable costs, dwindling savings, and a sense of systemic breakdown. Yet, for those in positions of power, it's a structured mechanism, a lifeline for the economy. It's the tool governments use to fund conflicts without hiking taxes, the method corporations employ to diminish their liabilities, and the secret weapon of the affluent, allowing their holdings to balloon while others struggle to catch up. The real puzzle isn't why inflation occurs. It's why society permits it to persist, generation after generation. To unravel this, we must journey back to an era when inflation was viewed as a crisis, not a managed objective. In the early 1900s, most economies anchored their currencies to gold. Paper money represented tangible metal locked away in secure vaults, ensuring scarcity and steadiness. This framework limited governments. They couldn't simply print funds to escape blunders. Deficits demanded tax increases or admissions of failure. Inflation, when it emerged, typically stemmed from wartime chaos or economic breakdowns, a sign of lost fiscal discipline. The notion of deliberately engineering inflation would have been absurd. Then, the world fractured. The Great Depression of the 1930s demolished the myth of monetary self-control. Prices plummeted, jobs vanished, and financial institutions crumbled. The economy stagnated, not due to inflation, but deflation. A scenario where money's value increased, discouraging spending and amplifying debts. It was a vicious downward spiral that revolutionized how leaders approached currency. By World War II's conclusion, inflation had evolved from a dreaded foe into a pragmatic instrument. Nations emerged from the conflict drowning in obligations, with some owing over twice their gross domestic product. Repayment through conventional means was untenable, so they allowed inflation to erode the burden. Throughout the 1950s and 1960s, global debts dwindled quietly, not from economic booms, but from the gradual devaluation of those debts. A war bond worth $1 billion in one decade might be worth a fraction later. The lesson was clear. Controlled inflation could resolve insurmountable issues without drawing attention. Enter 1971. President Richard Nixon severed the dollar's link to gold, a move intended as a short-term fix that became permanent. In that pivotal instant, currency ceased being a gauge of inherent worth and morphed into a policy lever. For the first time in contemporary history, the globe's primary reserve currency relied not on precious metal, but on collective trust. You could no longer trade dollars for gold. They exchanged only for more dollars. Inflation shifted from an unintended side effect to a deliberate feature of the system. From then on, the economic playbook transformed. Money could be generated endlessly, provided faith in it endured. Governments borrowed without boundaries. Financial institutions extended credit infinitely. Investors discovered that, in a world of steady inflation, savers weren't the victors. Borrowers were. Inflation inverts the traditional rules of finance. Holding cash leads to theft by devaluation, while owing money brings rewards. As prices climb annually, the true burden of debts lightens. A $1 million home loan that feels oppressive now might seem manageable in 2 decades, thanks to persistent inflation. Simultaneously, your holdings, be it property, equities, or land, see their face values soar. Inflation doesn't merely reduce debts, it multiplies fortunes. This lies at the core of the system's irony. The very force impoverishing the masses sustains the elite. It's not a shadowy plot. It's pure mathematics. Inflation sustains a credit-dependent economy. Without it, debts would demand repayment in currency retaining its original purchasing power, an impossibility in a system fueled by perpetual borrowing. Consequently, policymakers, central authorities, and businesses tacitly align. Tolerating gradual currency erosion is preferable to total meltdown. What does this mean for everyday individuals? The outcome is stark and demoralizing. Salaries seldom match inflation's pace. Expenses outpace earnings. Savings, traditionally the bedrock of middle-class stability, morph into a gradual drain. those reliant on wages rather than investments, living paycheck to paycheck, find themselves trapped on an endless invisible treadmill. Inflation favors asset ownership over toil, and it penalizes prudence. Thrift, once a prized trait, becomes a disadvantage. The system urges saving, yet imposes penalties for it. With a savings account yielding 3% while inflation hits 6%, you're not gaining. You're effectively paying to preserve stagnant funds. Conversely, those borrowing at 4% for real estate watch their investments appreciate by double digits. This isn't mere fortune, it's engineered. Inflation doesn't scatter wealth haphazardly. It channels it upward. Those nearest the money's origin, banks, governments, enterprises, access it while it's potent. By the time it filters to you, its strength has waned. This phenomenon, dubbed the Cantillon effect after an 18th century economist, highlights how fresh currency advantages early recipients before prices catch up. Centuries ago, it enriched monarchs and traders. Today, it boosts hedge funds and central banks. Inflation redefines not just costs, but hierarchies. Who thrives above the fray? Post-1971, the dynamics of finance inverted permanently. Overspending, once condemned, became lucrative. Governments gained unprecedented flexibility. As borrowing supplanted saving, inflation emerged as the unseen adhesive binding the economy. By the 1980s and 1990s, the framework had mastered equilibrium. Central banks pledged price stability, targeting about 2% inflation, sufficient to fuel expansion without alerting the populace to the covert levy. 2% seems benign, almost precise. Yet, across a lifetime, it halves a dollar's buying power. The disparity? While ordinary folks watch food costs double, the wealthy observe their portfolios double, and more. Steady inflation renders debt manageable, and the affluent don't dread it. They harness it. They possess appreciating homes, price-raising enterprises, upward-trending stocks, and debts that grow cheaper to settle each year. Inflation is their ally, a covert partner amplifying every edge. Authorities adore it as well. National debts diminish in real terms with prolonged inflation. That's why they'll combat deflation fiercely. It exposes vulnerabilities, burdens debts, bursts bubbles, and triggers defaults. Inflation conceals flaws, bridges voids, and shifts burdens downward. Financiers? They cherish it most, as it ensures an unending cycle of borrowing. With prices perpetually rising, saving becomes illogical. You must invest, pursue returns, leading to more loans, products, and complex financial instruments. Modern finance, from home loans to corporate buybacks, hinges on the premise that future dollars will be slightly less valuable. Yet, the lower you stand in this hierarchy, the less agency you wield. Wage-dependent incomes lag behind inflation. Asset-based wealth accelerates. Debt can either devastate or enrich, based on its type. A high-interest credit card is ruinous, while a fixed-rate mortgage offers leverage. The elite grasp this nuance, most do not. Thus, inflation converts insight into currency. The 2008 financial meltdown could have sparked a genuine overhaul. A chance to forge a fairer structure. Instead, it showcased orchestrated inflation. Central banks conjured trillions to salvage the system, channeling funds to institutions and markets rather than households. Asset values rebounded instantly. Equities and properties surged. Salaries stagnated. Quantitative easing, essentially printing money via bond acquisitions, sounded technical, but it was a monumental wealth shift via inflated assets. Owners prospered, renters languished. This wasn't graft, it was deliberate strategy. In 2020, the pattern recurred amid a worldwide health crisis. Governments funneled cash directly to families to avert disaster. Demand spiked as supply networks faltered. Inflation spiked to levels unseen in decades. History echoed. Stock indices reached peaks, housing became unattainable, and those profiting from low rates now capitalized on shortages. For a brief period, the public attributed inflation to corporate avarice. But this was the same opportunism the system had incentivized for years. They'd simply honed their tactics. Inflation doesn't arbitrarily select champions. It magnifies those with existing advantages. Examine any significant inflationary episode, and the motif endures. In 1920s Weimar Germany, the middle class was obliterated, while asset-holding industrialists amassed greater riches. In post-war Britain, inflation discreetly erased public debts while eroding savers' pensions. In 1970s America, equities flatlined, but property and raw materials enriched the capable. In the 2020s, The top 1% amassed trillions as median families fell back. Varied times, identical blueprint. Inflation stands as humanity's most ancient and esteemed wealth transfer mechanism. The masses fault avarice, politics, or logistical hiccups. These are mere indicators. The underlying issue is systemic. We've constructed an economy reliant on expanding credit, and that expansion demands inflation for survival. The alternative isn't equilibrium. It's ruin. Hence, when central banks vow to combat inflation, their true aim is containment, not eradication. They aim to simulate stability while the currency subtly depreciates. True zero inflation would halt expansion, jamming the machinery. Thus, the inflation battle is theatrical, a tightrope walk between trust and imperative. The Federal Reserve hikes rates, sparking market turmoil, only to pivot before catastrophe. At its core, all involved recognize minor inflation is a modest toll for preserving the facade. Beyond policy lies a psychological dimension. Inflation alters not merely figures, but conduct. It encourages immediate consumption over deferred planning, chastises patience, and glorifies risk. Saving breeds anxiety. Speculation offers optimism. This molds the ideal participant in a debt-fueled system, perpetually consuming, eternally discontent, chasing an elusive security. Thus, inflation evolves into a cultural norm. We label it expansion or prosperity, yet beneath lies a timeless cycle of depreciation, reinflation, and rediscovery. It sustains empires, lubricates banks, and pacifies the populace. Once perceived, it becomes inescapable. Inflation isn't arbitrary. It's how dominance gauges progress. It favors forward thinkers. Borrowers, investors, credit manipulators. It penalizes present dwellers. Earners, savers, spenders. It abandons past believers, those clinging to money's constancy. That's why the affluent embrace inflation, while you recoil. To them, it's not larceny. It's tactics. Each era unearths the same harsh reality. Currency's worth is fluid. The sole query is whether you're the loser or the arbiter. Inflation didn't materialize spontaneously. It's the inevitable byproduct of a society craving instant gratification, deferring costs. It's the subdued motor of obligation, the vitality of realms, the essence of a framework compelled to enlarge, even at the expense of its inhabitants. Yet, paradoxically, without it, all crumbles. Deflation annihilates debtors, bankrupts institutions, and halts commerce. Inflation sustains motion, regardless of casualties. This is the ethical calculus of contemporary economics. Advancement at any cost. So, when you encounter claims that modest inflation benefits the economy, recall its beneficiaries. Not the laborer scrimping for a home. Not the pensioner on a set stipend. But those already possessing the property, those who engineered the ascent to ensure it persists. Inflation isn't a capitalist flaw, it embodies capitalism, accelerating relentlessly with your finances as its prize. Ultimately, inflation isn't the blaze, it's the sustenance. The civilization we've erected cannot respire without it. If this perspective has illuminated your understanding, consider subscribing. History unveils truths, and I'll guide you to the sources.